Good morning. You're watching a live market outlook for Monday, 7th of November 2011, prepared by Windsor Brokers. The main subject in the markets in the past couple of days remains Greece. However, some solutions were found and some results came out after the resignation of former Prime Minister Papandreou. He actually sealed his fate after calling for a shocking referendum when the opposition and also the Eurozone members showed their anger with such decision after nearly hitting the agreement for a further bailout of Greece. The Papandreou sealed the deal with the opposition crisis coalition to approve an international bailout. Details are still thin, despite the EU ultimatum for Athens to get serious about tackling its huge problem. Greece is likely going to run out of money in the coming weeks. The European Union told its parties to explain by Monday evening how they would form a unity government to enact the 130 billion euros emergency funding package. Papandreou actually, as I mentioned, sealed his fate after disastrous attempt to call a referendum on a bailout. He's stepping down when the new government takes over, but still unclear, still no details about the whole cabinet. The conservative leaders came up with the bare minimum to satisfy Brussels, and they must still agree today who becomes the next prime minister to lead the nation, which is destabilizing the entire Eurozone. Eurozone finance ministers also will speed up today their work strengthening bailout to enhance its market credibility by the end of November, a month early, as concerns growth about Italy, Eurozone official said today. The Eurozone leaders agreed last week to scale up the 440 billion euro European Financial Stability Facility, known as EFSF, to convince markets they can prevent Italy and Spain from being swept up by the sovereign debt crisis, which has already claimed Greece, Ireland and Portugal. The agreement of the leaders of the 17 countries using the euro to leverage the EFSF by 4 to 5 times still needs technical details to be provided by finance ministers before the EFSF's bigger firepower can be demonstrated to the markets. Actually, the Greece sparked the panic in the markets and shocked fellow Eurozone countries by announcing last Monday a referendum to seek the citizens' approval for an emergency financing package that Eurozone governments, private investors and the IMF agreed on earlier talks in October 27. Greece is now back to the rails, and the continuation of the earlier agreed package for the next tranche of the aid will be likely provided with some details, as I mentioned, to be provided by the Greek government. The next burning point for Eurozone is also the Italy, as Italian Minister Silvio Berlusconi was left one day to win over waivers and see of a group of party rebels threatening to bring down his government in a backlash over its failure to adopt reforms to defuse a dangerous debt crisis. Just as a reminder, the sovereign debt of Italy is much higher than Greece, and it's around 1,900 billion euros. Estimates vary widely over how many center-right deputies will jump in a crunch vote of the public finance in the Chamber of Deputies, actually the Parliament, on Tuesday. Berlusconi's message to potential traitors is clear: you have nowhere else to go and you will be rewarded if you stay. They are now, it's actually the crucial voting from the Italian Parliament will give us, which is due tomorrow, will give us some more details about further developments in Italy. Just to mention that initial optimism regarding the finding solution for Greece and preventing further spreading of the crisis, it seems to be fading this morning as euro and sterling are again under pressure after a higher opening during the night, backed by supportive and positive news coming last Friday and during the weekend, as both instruments, actually especially euro, is focusing now to the downside. That will take a look later on in the technical part. Gold remains well supported as uncertainty raises about further steps of Eurozone in handling the Greek problem. The investors are mainly taking safe haven gold that pushed actually the price higher. That will be also we'll take a look in the technical part. The crude oil is higher as winter season starts surprisingly earlier in the States. Also the still disruption from Libya and North Sea supply, as well as quite low the weekly inventories released last Wednesday are supportive for a further price raise of the crude oil. From today's calendar, we're going to take a look now on today's calendar from Switzerland at approximately Swiss franc unemployment rate released earlier this morning comes at expected and forecasted 3%. Also the previous release at the same level, so no change. UK Halifax HPI at 1.2%, surprising raise from 0.1 forecast and negative 0.3 of the previous month release. At this moment we have a release of Swiss inflation forecast. Initial forecast was 0.2% compared to the 0.3% previous release. The release of today is minus 0.1% on a monthly basis, so it's below the forecast. Further to come at 10 o'clock GMT, retail sales from monthly retail sales from Eurozone, no change expected for today, minus 0.3% is the previous release. And then at 11 o'clock GMT, German industrial production monthly expected to further decrease from minus 1% the previous month, is expected actually to decrease by 0.7% according to the forecast. And that would be all from today's calendar. Now let's take a look on the technical part of our presentation and take a look on the majors and commodities. We are in euro hourly chart. We can see that despite a higher opening today at 138.25 with 138.29 high hit, the euro remains in defensive and currently losing the initial support at 138 and currently testing 137, which is the previous low of Friday, 137.10, and then we have at 137 the bull channel, short-term bull channel support, below which would further weaken the tone and open 136.55, the 3rd of November low, and key short-term support at 136.07. The hourly studies are turning into negative, from neutral to negative, now turning into negative, as the MACD is below their midline, as well as momentum. The RSI is pointing lower, and the 20 days moving average on the daily chart currently at 137.67, capping the near-term price action. Widening Bollinger's on the hourly chart are suggesting further movements to the downside, while upside remains firmly capped by 38.2 Fibonacci retracement of the broader 142.46 down to 136.07 descent at 138.50, along with the previous highs at 138.50 and 138.68. Break here is required to signal further extension higher. However, at this point the near-term outlook is more negative, and 137, 136.55 and 136.07 are in focus in the near term. Cable is also at the back foot after being capped again above at 160.60.70. Actually, this morning's higher opening and brief break above previous high at 160.60 has posted marginally higher high at 160.72, but unable to hold gains. Reversed immediately back. Loss of the initial support at 160 zone has now extended lower. Next level is strong support at 159.50, which is the 3rd and 4th of November lows, below which to turn focus lower and open way for key test of key short-term supports at 159.00, 158.75. On the broader picture, we can see that 200 days moving average currently at 161.40 is firmly capping the upside, and despite in the positive zone, the studies are weakening as the pair broke below 90 days moving average, and now looking for test of 20 days at 159, which is also strong support. On the short-term 4-hour charts, the studies are still in the negative tone, turning actually negative, and the loss of 159.50 and then 159, 158.75 to signal further weakness, and the fresh leg lower of the corrective pullback curve from 161.64. On the upside, the regain of 160.70, 160.91 is required to ease the current bear pressure. However, clearance of 200 days moving average at 161.40 and the break above 161.64 would change the current negative structure. Dollar yen holds the very narrow directionless trading mode. However, this morning announcement from the Bank of Japan that they have intervened several times after the main intervention from last Monday, it was not that significant in amounts traded, but however kept the pair steady around the 78 zone. Immediate support at 78 and 77.75 holds the downside for now. Studies are flat and showing no direction at this point. However, break above or below the extreme points on the downside 77.75 or 78.40, 79 on the upside is to give us a more clear picture and shows the near-term direction of the pair. Break above 79.52 post-intervention highs to open upside and open the 200 days simple moving average currently standing at 79.80 and capping the upside ahead of 80.23 our next targets. On the downside, loss of 77.75 risks return down to the previous 2-month range between 76 and 77. Dollar Swiss is in the positive mode this morning after a good support was found at 87.60 last week, and the latest break above previous high at 87.59 opens way for further extension higher. The pair has so far touched the 90 zone, which is our next target and psychological barrier, ahead of strong resistance at 90.81. That is next target is the high of 20th of October. Near-term studies are in the positive field and supportive for further gains, with the 4-hour 20 days moving average currently at 88.52, pointing higher and underpinning the current move. Immediate support at 89.15 and 88.32, while loss of trendline support at 88.25 would soften the current positive tone. Crude oil is showing some positive action in past two sessions, as we can see on the hourly. As a brief break above previous high at 94.58, posted marginally fresh high at 94.91. However, as seen on the daily chart, the 50% Fibonacci retracement of 114.80 down to 74.94 is still cupping. The market has dented slightly this level, which stands at 94.85. However, the 200 days moving average at 95.11 is still cupping the upside, and break here is required to signal a fresh leg higher and extend the recent recovery from 74.94 and open the next level at 99.55, which is a 61.8 Fibonacci retracement. And then we have a psychological $100 per barrel level and the previous high of 26th of July at 100.60. On the downside, immediate support comes at 92.85, while a loss of $90 per barrel, which is the key support on the downside, would be bearish in the short term. Gold is back to strength as shown on the daily chart, clearing the previous congestion under 1752 and extending so far to 1773, actually testing the 61.8 Fibonacci retracement of the 1920-1532 down move. The daily studies are now emerging from the negative territory, regaining momentum for a further extension higher and above 1800 to open 1820-30 zone next. On the short term, immediate support is previous high at 1752, which is the 1750 zone. Actually is now the breaking point in the near term, ahead of 1723, and then strong support at 1700, 1695, below which would be bearish.